Morgan Housel on the show. Now, Morgan, of course, is not only a global market commentator, his understanding of market behavior and how market cycle moves, and the fact that he's able to brilliantly correlate market mood, market behavior, and history of market cycles with the whole meter of fear and greed is quite extraordinary. Warren also is a believer that in the short term markets are noisy, in the medium term liquidity drives them, but in the long term, which is what long term investors should focus on, markets always align with economic reality. Morgan, what a pleasure to have you back on ET Now. Thank you for joining us. Now, Morgan, last time when we met, which was about 6-7 months ago, the mood was different. There was no cynicism, there was no skepticism, and there was only optimism. But after that, we saw a cracking fall in, or a crushing fall in US markets, and after that crushing fall, the recovery in US markets fall has been nothing short of extraordinary. So why do you think there has been so much of back and forth movement in markets? What explains this underlying bed of volatility?
Well, I think if you look at the long history of markets, we're always going through these periods of extended volatility. The periods of relative calm that we go through are what stands out over history as being odd and abnormal. The periods of volatility tend to be the more normal periods. Obviously, anytime you have a big national election, as I know just occurred in India, you have periods where you have investors just trying to size up what's going to happen to the economy in the near term, what new policies are going to be put in place, just a lot of uncertainty going in and out. And so that can have an effect in terms of increasing volatility. But I think in terms of, we had that in the United States as well. At the end of 2018, we had a very large period of volatility, and our market fell about 20% in a period of 2 or 3 months. But if you look historically, that kind of volatility, a 20% decline in the market, is something that would happen 3 or 4 times per decade. It's not something that's that rare. And if you're a long-term investor, it's what you should expect to experience on a fairly regular basis.
Morgan, for the moment, the bulls are excited. Everyone is everyone is of the view that Fed and low liquidity environment will keep this market moving higher. But some would argue that the current leg of the bull market, at least for US markets, is the longest we've seen post Second World War. And mean reversion is the biggest truism of capitalism. So when do you think mean reversion will kick in?
Yeah, if we were talking 10 years ago in the United States, and it was the middle of 2009, we had already had a reasonable rally. Our markets bottomed in March of 2009, and then even by June or July of 2009, a lot of people were saying it's gone too far, too fast. And then virtually every year since then, you've had people saying, it's been going on. And if you had been talking to me 5 years ago or 3 years ago or this time last year, I would have told you the same thing, which is it's gone on a long time. Investors should probably temper their expectations for future returns given how long it's gone on. But just because something has gone on a long time and just because something looks unsustainable does not necessarily mean that you know when it's going to end. I think those are two very different things, seeing that something is unsustainable and knowing how long it can sustain for. And what I always say is investors, rather than having a forecast of when this is going to end, they should just have an expectation that it will end at some point eventually. And if you come to expect volatility as an investor, if you come to expect years where you have returns that are lower than they were in previous years, rather than predicting exactly when those periods will come, I think it's a much better set for investors to have over the long term, rather than trying to predict specific dates. Just knowing that these kind of things will come to an end, and that over the next 10 or 20 years, there's going to be bad years, there's going to be bad decades even, but over a long period of time, you're likely to do well as an investor. That, I think, is the best philosophy for investors to have.
Right. So, Morgan, in your understanding, how should investors, and when I say investors, long-term investors, approach big events? And I'm sure by now you are aware of the mandate which Indian voters have given to the current government. Given that we've seen several binary events in the nature which tends to change the market rhythm completely and totally in the short term. Some events are political in nature, sometimes they are military in nature, sometimes they are financial in nature. But how does one really maximize their returns and minimize the impact of volatility when you are pitted against such binary events?
Well, one thing I can tell you about what happens for big presidential elections in the United States And what our history is, not necessarily that this will apply directly to India, but what our experience has been is that after every election, you have a bunch of investment recommendations and theories that make a lot of sense in terms of what industries are going to do well, what industries are going to be poorly given the new president who's taking office. I'll give you a few examples. When President George Bush was elected in 2000, a lot of people said, oh, he's going to deregulate the banks, buy bank stocks. And that made sense. But bank stocks ended on over the next 8 or 10 years doing terribly. They were one of the worst industries you can own. When President Barack Obama was elected in 2008, a lot of people said buy green energy stocks, solar companies and whatnot, because he's going to do a big push for green energy. And those companies ended up doing terribly during the last decade. One of the only industries that lost money during that period of time. So just because these things make sense that this president was elected and therefore these industries are going to do well does not necessarily mean that that's what the market is going to do. Markets are based off of things like expectations, and there's all these kind of other variables that play into how those industries are going to perform over the time. One thing that we have learned about investing in the United States is that presidents have less influence over the economy than some investors want to assume. It doesn't mean they have no influence, but less than they want to assume. And oftentimes when you're trying to think about what the president is going to do for the economy, whether you voted and like that president, or prime minister, for example, or you voted against and you don't like that president, has a big impact on your views on how you think the economy is going to perform afterwards. So the long history in the United States of investing around presidential elections is not very good. And I would say if you are an investor who was bullish on India 2 weeks ago, I would still be bullish on India today, regardless of how you expected the election to play out. And if there are certain companies that you're investing in that you think have competitive advantages that are going to do well over a long period of time, the election, by and large, on average, should not be influencing those views in a big way.
Right. So, Morgan, how does one really pick out the next big trend? Long-term investors would say that, look, we bought GE, but if a company like GE can really be kicked out of the Dow, which has never happened in last 100 years, then it's time to really understand that in today's disruptive world, the whole theory and theorem which is around long-term investing seems to be changing. Any investor would like to say, okay, how do I identify the next Microsoft? How do I figure out what the next Amazon is going to be? So whereas long-term investing has got its own benefits, but in today's disruptive world, the whole proposition of long-term investing is changing because you've got cycle within cycles now.
Well, yes, I think they should, because long-term investing does not preclude being well diversified with a portfolio of companies. And even if you look at General Electric, which has got kicked out and was the longest held stock in the Dow, but now has performed terribly. But the Dow itself has done well because it's a diversified group of 30 companies. And you're always going to have periods in the market where a very small percentage of companies drive most of the returns. Even if you look at the S&P 500 companies in the United States, fewer than 10 drive most of the returns. Amazon, Facebook, Google, Microsoft, those kind of companies drive most of the returns. But if you are diversified within that and you're not putting all your eggs in one basket, then the tenets of long-term investing still hold up. And this is especially true if you're looking at a very diversified portfolio of 500 or thousands of companies. And even though you have a small section of those companies that is driving most of the return, which is always how it is, even if you have some diversification within those companies, it increases your odds of doing well over time. Not to 100%, but to a degree that I think most investors can be comfortable with. If there are any exceptions to this, it's maybe a company like Berkshire Hathaway. But it's a very diversified company and is in many different industries. It owns many different businesses. It's almost like its own kind of index fund. But in general, certainly if investors are putting all of their money into one company, or let's say fewer than 10 companies, then it increases the odds that they will well over time, but also increases the odds that they are going to have a poor performance over a long period of time.
Morgan, classic investors say that the first sign of a bubble always comes from the IPO market when there is irrational pricing there. A couple of days ago, Uber has gone public and the response has not been great. Uber may be a valuable company in terms of the service they are providing, but for financial investors, it's a company which has admitted in their prospectus that we will never make money. How does one figure out madness in the investment world? Because if you are an investor, you are ultimately buying an asset which has got compounding earnings and which has productive in nature. But here is a company which has gone public, has commanded valuations of $80-90 billion, and has clearly indicated that we are a technology company and we will never make money.
I think one of the big trends that we've seen in private markets over the last decade are companies that make very good products, but the underlying businesses underneath those products are not that great, or they lose money, and some of them don't really have any prospects for ever making money, and some of them readily admit that. And those companies are either going to have to figure out a new business model or different lines of business that will generate stable cash flows over a long period of time, or particularly when there is a downturn, a recession, and funding dries up, some of those companies are going to have a really difficult time. One example I always give is Michael Dell, the founder of Dell Computer, last year released the financial statements that he used when he started Dell Computer in his dorm room in college. And even when Dell was a dorm room company, they hadn't even graduated to a garage yet, they were earning like 20% net profit margins. And that kind of stuff just rarely exists today. So that used to be the norm of how startups worked. Startups were profitable, and they still needed to raise money from investors, but that was to fuel expansion, to build new factories and whatnot. They weren't subsidizing operating losses. So, there are companies that do figure out new profitable ways to operate. The best example is probably Facebook, which for years barely had any revenue, let alone profits, and now is one of the most profitable companies in the world. Companies like Amazon as well, that was always doing okay, but then it came up with AWS, which is just printing money that can help subsidize the retail side of the business. So it's not black and white that either these companies are all gonna go out of business or they're all gonna do well even though they're losing money. But a lot of them are gonna have to figure out new ways to make money and earn profits. Otherwise, they're gonna have a very difficult time during the next downturn.
Morgan, you've always been a big practitioner of fear and greed, which is that good news and good prices, they rarely come together. Right now, we are in an environment where the globally news is not great. The fear of trade war, fear of what will happen to Japan, how exactly the US economy will move because the sugar rush soon will get over. But even though the headlines are not great, markets are at an all-time high. Historically, when the headlines are bad, stock prices, they always correct. Everybody is waiting for a correction, the environment is slightly noisy, yet asset prices are getting inflated. Why is there such a dichotomy?
One thing that I think is interesting right now is the extent to which we've had a 10-year bull market and markets have done really well and a lot of people have made a lot of money. But at the same time, so many investors around the world are still scarred from the 2008 financial crisis and how much money they lost during that period. And it's this weird dichotomy of trying to find the balance between those two emotions. I've made a lot of money in the last 10 years is what most investors say, but I'm still scared of what happened in 2008. I'm scared of that happening again. And I think the balance of those two emotions, I think probably still leans towards fear of 2008. I still think the fear of 2008 is one of the prevailing sentiment drivers of global markets these days. Even though valuations are high, even though interest rates are low, even though markets have done so well, I think investors are much more on edge than they would have been, say, in 2007 or in 1999 or 2000. I don't think where we are today compares to those. That's not to say that people should temper their expectations of future returns or that they shouldn't, be prepared for, what might look like greed today turning the other way and turning into a fearful environment. Of course, that's always a chance. But I think 2008 still prevails, and I also think it will prevail for a lot of investors the rest of their lives. It's something similar to the Great Depression, where it was so powerful and so traumatic that it's something that sticks with people for the rest of their investing careers.
Well, the investment world is famous for writing newsletter. The annual letter from Warren Buffett, the memos of Howard Marks, the newsletter which comes from legendary investors like Ray Dalio. They really pour in their understanding of the world and how they have learned over the years by simply observing and participating market cycles. So if you have to write a letter to your boy who's 3 years old, how will that letter start and how will that letter end?
Well, I have a son who's just over 3 years old. When he was born, I did write him a letter about my financial advice that I would give him. And it began by looking at investing not through investing recommendations or anything like that, but just thinking about what good money is and what money does for you and what money does not do for you. and thinking about the difference between having possessions, buying things, buying stuff, versus having control over your time, or versus using money to help other people and take care of your family and give your family options and safety and security. That's how I would begin it. And I think it's important for investors to think about this, because rarely do we take a step back when we're thinking about investing, talking about interest rates and profit margins and whatnot, to take a step back and say, what are we doing this for? What is the purpose of this? And that seems like a silly question for people who say, well, more money is good, which it is for the vast majority of people. But what are we going to use that money for? I think is a very important part of investing and the big process of investing. And are we using this because we want more stuff, or are we using it because we want to retire early or gain control over our time or take away worries and risks from our families? I think that's a really important topic that gets left out of this conversation too often.
Now, Morgan, you were in India 6 months ago, and by nature I know that you're a curious person. You love to observe, you learn to digest and then assess the situations. So what is your understanding of how India is stacked up right now?
Yes, I would say so, because kind of the fundamental drivers that drive investors are just who we are as humans. It's not what country we're from or even what generation we're from or what we've experienced. Those are big factors. But a lot of what drives investors is dopamine and serotonin. It's things that apply to me and you in equal amounts. Even if we're from different countries and have different backgrounds, we're driven by the same, fundamental drivers of what we're going after. So yes, I would say investors, not just in India, but other places I've been and met investors, in Australia and Africa and whatnot. We're all playing the same game, and we're all doing, we all have very similar goals and similar expectations, similar fears and whatnot. I think that tends to be ubiquitous across the world.
So, Morgan, in today's world where everything is really available on internet, WhatsApp, the line of communication are very universal in nature, how do you think the average investor has changed? The investor in 1950s was perhaps not aware, was not informed, and was not connected. So in terms of the investor psychology approach, do you think a lot has changed, or it is still the same way investors are well informed but they pretty much fall into the trap of fear and greed?
Well, it's great that investors have more information. And you just compared it to 1950. I think even comparing it to 2009, if you just go back 10 years, there's so much more information today than there was back then. And that's great. So I think investors are better informed today than they are back then. But there's this other side of it, which is the behavioral side of investing. And I think investors are maybe more susceptible to behavioral pitfalls today than they were back then because they have more information. They have more information to cherry pick from, and they have more information to figure out what kind of investments that they want to look for, to kind of send them in different directions as investors. So even though they have more information and are more informed, I think the behavioral side of investing is always going to be there for investors.
So, Morgan, closing comments. I mean, you were in India a couple of months ago. How would you assess the country? As a person, I know you're curious by nature, you love to observe and you love to digest. So what is your understanding of where India currently stands, both in terms of economic positioning and also in terms of the demographics advantage?
Well, I think my visit to India last year was incredible. It was my first time there, first time seeing everything. The size of India is something that most people in the United States just can't comprehend until they get there. There is just so much more of what's going on in India than we could ever comprehend in the United States. So it's really it really just took me aback about how much is going on there. So, I mean, it's a company that has just an amazing amount of opportunity, because you have on one end a lot of great infrastructure, great companies. And on the other hand, a middle class and below that can have so much room for growth, which is something that we generally have in the United States, because a lot of that growth took place over the last 200 years. So I can't think of another country other than India, more so even than China, I would say, that has the opportunity to bring up so many people into the upper echelon of growth in the modern economy. So it was really just a really inspiring country to go to. I really enjoyed my visit.
Okay, Morgan, really appreciate your time. Thank you for joining us.